What is going on YouTube? It's Sank. We are back with another one. Now in this drop, coming at you guys with a play I want to bring to attention. Before I kick things off, if you'd like to help out the channel by hitting that like button because it keeps the show rolling. Alright guys, so as always, ahead of tomorrow's opening bell on the stock market, and to make sure that you guys have the game plan as we move into next week to ensure that you guys are in the right lanes, picking up the right types of plays so that we can have a strong finish this year. Now, there's a ton of moving parts in the markets right now. We're deep into earnings season. A lot of companies reporting their numbers. We've got some at all-time highs, got some at 3-month lows. So what I want to do is I want to decode the market for you guys and put a play on your radar that is due for a strong finish this year. So as always, got a jam-packed one for you. So let's run the play. Alright guys, so the play I've got for that ticker symbol MTCH, that is Match Group. Now this one's making its debut on the channel. Now, as I say, I'm going to make sure that you guys are moving in the right lanes, taking full advantage of all the money making things we're seeing as investors. For example, on the shipping side of things, we've got a quality play over there. Now the reopening trade, there's going to be plenty of winners. We are already in Revolve and they're taking advantage of what we're seeing in retail, set for great things. On the tech side of things, we're in plays like Snap and we've already hit phenomenal numbers. This is another tech play to take advantage of the reopening that we're seeing. Now, Match should need no introduction. They've got a rich portfolio of businesses focusing on online dating. Now, during the pandemic, this one was held back. There was a couple of roadblocks in their journey of growth, but in an environment of that transition from the stay-at-home movement to reopening, with bars open, with restaurants open, you can bet they're going to see a ton more activity on their platforms. That's going to feed through to some phenomenal numbers. That's why I say I want to make sure you guys get in on the play, and it's time for us to enter this one. Now, if we check out the charts, they've been consolidating for the whole year, guys. That is trading sideways. At the low end of the channel, around the $135 mark. At the high end, the 165, the 170. So this one is moving like clockwork, as I say. When you see a play consolidating, it means they've got a strong line of support. You've got a lot of investor conviction to buy the stock when it hits that level. And obviously, naturally, you've got some profit takers when it hits the top of the channel. I told you guys, one of the biggest reasons the stock breaks out of consolidation is because they post up good earnings that surprises the street. So you can bet that this play, as we can continue through reopening, as I say, it's going to be doing very well behind the scenes. So it's only given they are going to surprise the street in their next couple of quarters, causing a breakout of consolidation. That's why I say I want to get you guys in on the action so you guys can net some great returns on this play. Now, in terms of exit strategy, as I told you guys, any play we enter, we always have our exit strategy from the jump. We're either short term in the play, we're either medium term, or we are long term. This is a play that has long term potential, but we're going to take it from a shorter term perspective, okay, because of the valuation. The valuation is a little bit on the high side for me to take this as a long-term play. So what we're going to do is we're going to make entry in and around these types of levels. If we can catch this one under 160, we make entry. We take this one up to $200. We net our returns, then we rotate that to the next winning play. That's how we're going to hit success with this one. Alright guys, so that's just another winning play I've got for you and the moves we're going to be making with as we get prepped for another action-packed week in these markets. So as we head into another busy week of earnings, and to make sure that you guys are up to speed on all the earnings jargon and how we can use those results to our advantage as investors to make money. Now in the previous drop, I spoke to you guys about there's two key figures we're looking out for any company when it releases its earnings. Those are its revenues and its earnings per share. Now I spoke to you guys about what we do, how we position ourselves when we get plays that beat those estimates. In this one, I'll talk to you guys about what we do, how we position ourselves when we have plays that miss guidance numbers, okay? So we've got to split it up because it means different things when a company misses revenues or when it misses earnings per share. So when a company misses revenues, first up, guys, we got to see how much they've missed revenues by. Now, if they've missed revenues wildly, that's a cause for concern. Now, none of our plays miss revenues wildly simply because I get you into leaders in their respective fields. If they're going to be leaders, they're going to be the ones with the biggest customer base, the best brands. So ultimately, they're going to be making the most revenues. So it's a given that they're going to smash revenue targets. Now, if there's a small revenue miss, you can give leeway to this, especially if this is a play with momentum. There might be a cause for concern. Maybe there's some supply issues. Maybe there's other things going on that cause that slight revenue miss. There's no need to panic if it's a small revenue miss, and that is the situation, okay? So to make sure that you guys are clear on that. Now, things are going to get very different when we talk about an earnings per share loss. When it comes to growth plays, we can give a lot more leeway when it comes to that earnings per share number because they're more early stage and they've got some operational tweaking they can do, versus a large cap, mega cap play where we want and need them to also smash their earnings per share number. So on the growth side of things, as I say, leeway can be given. And we've seen that time and time again. Take a higher car, for example, smash through revenue targets, and we want our growth plays to do that. But earnings per share, they missed the number, but the stock went up 45% on the day. So as I say, earnings per share is less important for these early stage growth companies. Revenue growth is much more important, but this is the key. We want to see improvement in their earnings per share quarter after quarter to show that they're becoming a little bit more operationally efficient. Now, this is where we can make money as investors. If we see a play drop down on earnings day due to an earnings per share loss, but their revenues are firing on all cylinders, and we can see an improvement in that earnings per share number over time, that's a money making opportunity to get in on the play off the back of an overreaction in the market, because we know when they post up their next quarter, earnings per share number is going to come in much better shape. You'll see that stock price rise. That's how we make money as investors. So if you've been rocking with the channel, you know what time it is. Do you think Tesla is good on Monday or Tuesday to sell? I have some stocks of Tesla. So to wrap this one up and the shares from you, in light of Tesla's earnings coming out tomorrow, I'm going to give you guys my 2 cents on the play, what to expect, and how you can position yourselves as investors. Now, first up, Tesla remains a strong long-term play. I see good return potential for investors, but what you guys got to know is there's a ton of headwinds in the market for these automobile plays, coming from raw material price increases, coming from supply chain issues. That is going to be a theme for the rest of the year at least. Now, that being said, with that information, you guys can position yourselves accordingly. So if you can't stomach high levels of volatility, I suggest you guys set your stop losses on the play or set your trailing stop loss. So if the play comes down, you can net great results. You can still net the W, and you can choose to buy back in later if you catch a price point that you like. Now, if you've got a great average, if you can stomach volatility in the play, then you can choose the dollar cost average down if you get a better entry price. Okay, so those are just the 2 ways that you go about navigating a situation like this one. But to wrap this one up, so I'm going to give you guys a little bit of 2 cents, a little bit of coverage on Tesla as we head into earnings. I'm expecting good numbers from the play, but as I say, there are several headwinds that will come into the scene, into the picture over the rest of the year. Alright guys, that wraps up for this one. If you've got any questions for me, drop them down below and I'll get back to you. As always, I appreciate you. On your way out, light up that comment section for me. If you're new, join the movement, and I'll catch you on the next one.